Joining us now is Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, hello to you. Thank you so much for being with us. Certainly in that commodity space, we are seeing oil making a move once again higher. How are you viewing what is relatively choppy trade of late for oil?
Yeah, it definitely has been a very narrow but volatile trading range, a $5 trading range. And really, once again, headlines and sentiment basically rule the day over anything else. And we know that most of the data that's come out has been somewhat bearish, especially in the inventory. When it comes to stock, it's been moving sideways. However, every indication is that OPEC and non-OPEC producers alike are complying very quickly to the quotas that they've put forth back in November. And I think that is giving some confidence, momentum to the market. And we're going to see it draw probably a little faster than most people expect. Right now, it is right in the middle of its range, but I do expect to see oil moving higher in the short term.
How is this feeding through then into performance in the energy sector? We're certainly keeping the technology space and infrastructure in focus today, but just give us some color around the energy sector.
Yeah, what's fascinating about it all is that there's some lack of correlation right now between petroleum prices and perhaps energy stocks. I mean, you figure the S&P 500 year to date up just shy of 1% after today's action. One of the biggest underperformers has been the S&P 500 energy sector, which is quite perplexing given the most recent sturdiness in petroleum prices. So that said, product development and product news has all been fairly bearish. Makes a lot of sense, though, given that we're in a refinery maintenance season. Be very fascinated to see what happens going forward, especially if we see more tailwinds with oil prices, because we haven't seen it benefit gone through to the equity sector.
With that in mind, we're also very much watching the correlation, or indeed inverse correlation, between the dollar, the greenback, and also oil. That inverse correlation certainly returning a movement absolutely in opposite directions. We have a chart on screen for viewers now, and just to flag, that white line is the Bloomberg Dollar Spot Index. The blue line that we're seeing absolutely moving in the opposite direction is WTI. Larry, just talk us through this correlation, particularly as that greenback weakness continues, and we are seeing on month pretty poor performance.
Yes, and Natalie, I know we spoke about this before, and I don't have that chart in front of me, but for so long, oil and the dollar, there was no correlation whatsoever. It seems like the dollar had its own mind made up. Oil didn't follow suit, but now all of a sudden the correlation is back. And generally speaking, that is so with most of the commodity sector. I think with the U.S. dollar in mind, I, for one, continue to think that it's overshot, and I think it's definitely due for a pullback. We have to keep in mind that of the majors, global economic data has been, much better, well, not much better, relatively better outside of the U.S. The U.S. is playing catch up, and I think there's going to be a pretty good reversal. If not, just be careful that I think we can see those dips, because the dollar has overshot on a lot of prerogative, which really isn't coming to fruition. And given the fact that the data around the world is starting to move a little more quickly relative to the dollar, I think there's going to be some potholes ahead.
In terms of those potholes, just walk us through your pricing action. We're already seeing forecasts start to come through for 2018 and expectations in the year and indeed years ahead. Just guide us through sort of where you're pitching this.
Yeah, well, I think with petroleum in mind, I'm looking at WTI at the end of this year, somewhere near $60 a barrel. And there's going to be a lot of puts and takes along the way, obviously, but I think we're going to get into a market that's getting closer to being balanced, closer to reality. And 2018, I think it's going to be slowing down, but I still think we'll see WTI in the mid-60s by the end of 2018. But as we know, it's hard enough to forecast what's going to happen tomorrow, let alone next year. But it just seems logical at this point, given what we know, what's in front of us, that we're going to get into a more of a balanced scenario, and we'll see some drawdowns, especially when we have Indian and Chinese demand picking up as it has.
Just to get your focus lastly, just to switch focus indeed onto iron ore, certainly seeming to be on the mend, Larry, or in fact set to post its fourth monthly gain amid China demand. In fact, we have a chart on screen just flagging that increase that we are noting there. Again, how closely do you watch the iron ore space, and I guess subsequently, as we discussed already, its impact on miners globally also?
Yeah, no, my fund definitely has. We're trading. We have positions in all the metals, including iron ore. Iron ore and zinc both have been very tricky. I mean, other than that, you could say that the metals complex definitely has gone up in price, but it's a far cry from where it needs to be in terms of the cost curve. Iron ore definitely the exception. My positions in it are very small, given the dislocation between fundamentals and price action. Whenever something gets too volatile, doesn't make sense, it's always better to wind down. That said, I do believe, or I am constructively cautious on the price of iron ore, especially going into the first half of 2017. However, there's a lot of road that has to be laid before we get there, and I think it's going to be really, really volatile between now and then.
Larry, we will leave it there, but thank you so much for your time and comments today.
Thank you.